Okay, it's 9:01, so we'll go ahead and get started. Good morning, everybody, and I want to thank you for joining our webinar on lease accounting today. This is going to be the final webinar that we are doing in our series on lease accounting. And as a reminder, you can go to the SSF YouTube channel to see not only this webinar, but all of our previous webinars on lease accounting, as well as a bunch of different videos on a variety of other topics that may be of interest to you. I know we've got a bunch of things out there related to the functionality of Sage Intacct and a bunch of videos related to certain tax matters that you may find of interest. You're going to notice that the chat function is disabled today, but the Q&A function is enabled. So please put your questions and comments in there. And we're going to do our best to respond to those during the webinar today. And if we don't get to all of those questions, we'll follow up directly with you after the webinar. As is typical here, this is being recorded, and the slides and the link to the recording will be sent out over the next 24 hours. Dee, can you just confirm that we are recording already?
Yes, we are.
Note on that. Great. Okay. Perfect. So once again, we're going to be offering CPE credit for today's webinar, and that means that we'll have some polling questions that'll pop up about every 15 minutes or so. So bear with us on that. And we do need to get to about 55 minutes in order for everyone to qualify for CPE, which should not be a problem for us. I'm joined today by Joe Burnell, Senior Manager in our audit practice, who's really leading our efforts on the accounting side, and then also by Jess Vento, who's the Senior Director of Accounting at LeaseCrunch, which is our technology provider. And a little bit later during our presentation, Jess is going to run through a relatively detailed preview of the LeaseCrunch software. And I think it'll be very interesting for all of you to see that, see how easy it is to use and how simple it is to navigate your way around there. And, from my perspective, having a technology solution totally makes sense. And so please keep that in mind as you watch that demonstration a little bit later in our presentation. Here's just a quick commercial about SSF for those of you that may not know about us. We are a full-service accounting, consulting, and advisory firm. We have 4 offices in Northern California and 2 in Oregon, and a couple of hundred kind of scattered throughout the US as we've moved to more of a national practice in terms of hiring. Many of us are still working remotely, so that's why we've got offices all over the place, which really makes it a lot of fun from a technology perspective, trying to maintain all of that. And from our client base, we serve clients across the US. We've been in business for over 40 years. In addition to audit and tax, the consulting group, which I lead, offers a wide range of services, including fractional CFOs and controllers, outsourced accounting, internal audit, and a host of technology solutions. We're also one of a handful of accounting firms that's B Corp certified, and that's a designation that indicates we strive to balance purpose and profits. You're probably hearing more and more about that in the news today. You can find out more about that on our website at www.ssfllp.com, and then look for the Sensiba Center for Sustainability. There's a ton of information there that I think you'll find useful if you're interested in that. We've got a number of resources internally that are currently helping clients navigate through this. And you may have noticed that we recently launched our partnership with a company called Impact IQ, which is a fantastic ESG assessment tool. If you're interested in that, please don't hesitate to reach out to us. We'd love to engage in a discussion with you on that. And then specific to SSF consulting in our outsourced accounting and internal audit solutions, like I said, there's a host of technology services that we offer utilizing the software partners that you see on this screen. Today's topic is accounting for leases, and LeaseCrunch obviously is listed there as well. But we would be happy to speak to any of you relative to any of the software packages on this slide. And what we've seen kind of coming through the pandemic is, many companies wanting to go more and more to the cloud and implement a lot of tools that'll make them work a lot more effectively. Okay, so here's our agenda for today. As we've talked about previously, we're going to cover 842 primarily from the lessee perspective. Some of what we're going to talk about today is a bit of a refresher from our previous webinars. Today, we're going to focus on discount rates. As the interest rates start to move, we get a lot more questions relative to that. So Joe's going to cover that and dispel some myths that are out there. We're also going to talk about some tax considerations, which we haven't covered before. And then some best practices for lease maintenance and administration, as well as some post-implementation items that you may find useful to you. And as I mentioned, and I will continue to mention, utilizing a software partner for this is really, really the way to go. And we'll wrap up with that demo of LeaseCrunch towards the end. Please, if you have questions, don't hesitate to put them into the chat. We'd love to answer them. And if you've got a question, I can guarantee you someone else on the line probably has that question as well. Okay, so just a quick refresher here. The standard was effective for public companies all the way back in January of 2019. And with everything that's been going on in the world since then, it was delayed a little bit for private companies and not-for-profits, and became effective essentially on 1/1 of 22 for a calendar year-end company. So you don't necessarily need to report on this until next year end. So, kind of think about that March to June timeframe, depending on what your year end is and what your need to report is. But our advice here is get out in front of this. This is not something you want to leave to the very end. At the end of the day, if you don't have that many leases, this is not going to be really that difficult to do. It's just something that's new, so it takes a little bit of time in the first year. But this is not something you want to leave to year end. It's just going to push it into a time when you're already stressed and you've already got a lot of other things going on, and then that deadline starts to stare you in the face. And so our recommendation is to get out in front of this as quickly as you can. And we're here to help, right? We can do as much or as little as you would like. We'll cover that in a later slide. But at the end of the day, what's going to happen, all of your lease liabilities are now going to be on your balance sheet. So it's going to have a different look and feel by the time we're done. And like I said, if you've only got a handful of leases, this is not going to be too difficult. But if you've got a lot, then you certainly want to get out in front of that as quickly as possible. Joe, why don't you take us through some of the refresher here on discount rates?
Sure, happy to do that, Frank. So what we're going to just do is just start with a high-level refresher on this topic. So starting with the adoption of the new standard, companies are going to expect to see a significant increase in the number of leases reported on their balance sheet. Selecting and estimating that lease discount rate will have an impact on the lease liability and that right-of-use asset calculation on the balance sheet. So for a lessee, the discount rate for a lease is the rate implicit in the lease unless that rate cannot be readily determined. In that case, a lessee is required to use its incremental borrowing rate unless they elect the practical expedient to use the risk-free rate, which we will discuss shortly. Okay, so let's start with our implicit rate. So you can see the definition here on this slide. And to determine the implicit rate, the lessee needs to know the assumptions used by the lessor in pricing the lease, including things like the underlying asset's fair market value, the estimated residual value of the underlying asset at the end of the lease, and the initial direct cost deferred by the lessor. So you're probably asking yourself, what is the result? Most lessees don't have that information readily available, and it's going to be a challenge to acquire that information from the lessor, and you're really not going to be able to calculate that implicit rate on your own. So first step is really, we're not seeing that rate used much in the marketplace unless it is stated in that lease, and that's kind of a rare occurrence. So let's move on to the next one here, which is the incremental borrowing rate, or IBR. You're going to hear that acronym tossed around a lot. So if you hear that, that's what that refers to. So what are some examples of what the IBR could be? It could be rate on existing debt. It could be borrowing rate of similar entities quoted by a lender. If a lessee does elect to use this incremental borrowing rate, you can use one rate across a similar group of assets, maybe a vehicle fleet, for example. You don't have to calculate that for 30 trucks you might have in your fleet. You can calculate that once for the entire fleet. This is what's known as the portfolio approach, and we've kind of discussed that earlier in some of our other webinars. So if you do need some more detail on some of the nuances, calculations, recommendations, and/or myths surrounding this incremental borrowing rate, I encourage you to go back to our YouTube page because we have some of our previous webinars on there that really dive deeper into this topic here. Now, one thing you do need to be careful of about the IBR, and I'm going to kind of stress this again today, is it has to be tailored to the assets under lease. You can't just say, well, this is my rate on my line of credit, so that's my incremental borrowing rate for every one of my leases I have. That's not really how it works. So really what's important is you have to consider things like, maturity of the lease, terms of the lease, collateral associated with the lease if you were going to borrow against it, the economic environment that you're working in, any entity-specific credit risk factors that could apply to obtaining lending. So again, what I'm trying to stress here is calculating this IBR. It's not impossible. A lot of companies are doing it, but it does take time, inputs, judgments to get through that exercise. So next slide, please.
Yeah, Joe, just one thing while we stay on this slide.
Yeah.
You mentioned the concept of practical expedient, and we haven't really touched on that in this webinar. We did in earlier ones, but think of that's something that's supposed to help make it easier for you to implement. So there are several practical expedients. Once again, you can go back to our previous webinars and see more about that, or get us on the phone. We'd be happy to walk you through some of those.
Yeah, great point. The easiest way to think of a practical expedient, I'd call it a shortcut. It's designed to save time in the adoption process, and we're seeing a lot of companies choosing to elect many of those expedients. Okay, and speaking of practical expedients, we have one here. This is a discount rate alternative, which is using the risk-free rate. So if you don't know what your implicit rate is, if you don't want to calculate your incremental borrowing rate, a lot of companies are just deferring to this risk-free rate. This is a stated rate, as you can see on the slide here, based on the US Treasury rates. Now, one thing to consider is this rate is going to be lower than the implicit rate or the incremental borrowing rate. So in theory, it would result in a higher liability on your books if you do make that election, which in turn could affect some bank covenants or key ratios. But again, we're not seeing too many dramatic swings in any covenant calculations. And what I'll stress a little later on, again, is that just talking to your banker about this new standard and how it might affect your liabilities or your balance sheet or any covenants, it's always good to have that conversation up front. So just a little advertisement for you there. Now one thing to keep in mind here is everything that I've talked about today regarding discount rates, all of this needs to be disclosed in your financial statement. So it's not just I make a decision to use a rate, it's also what decisions went into selecting that rate, how is it calculated, what are the judgments behind it. So there's definitely some legwork to do in this first year of adoption surrounding your discount rates. Now, one thing I want to, without getting into too much technical detail here, the original standard did not have this requirement here, but there was an audit standard update that came out 2021-09. All it really said was, if a lease does have the implicit rate known and stated in that lease, you are required to use that rate. So you can't use the IBR or you can't use the risk-free rate. So just keep that in mind. If by chance your lease does have that implicit rate stated there explicitly, you are required to use that. But beyond that, then you can elect to use the risk-free rate alternative for any other lease that does not have that stated there.
Hey, Joe, one thing we talked about, and I want to make sure we give an example of this because this confuses me every time we talk about it, is what date is that interest rate supposed to be as of? So let me give you an example. So say I entered into a lease in January of 2018, and I'm adopting the standard as of 1/1 of 22. Do I go back and use the interest rate for the term of the lease as of 2018, or do I use it as of 2022? And then is it the full lease term or the remaining lease term at that point?
Great question, Frank. We're seeing that a lot from many clients I'm working with in the marketplace right now. So the answer is you would select the rate as of 1/1/2022, which is the first date of that adoption, and you would also apply that rate to the remaining term of the lease. So you're almost pretending like January 1st, 2022 is the first day of that lease. We know that's not the case, but as far as the accounting treatment goes under the new standard, that's how it would be accounted for.
Okay, and we got a question on materiality here. So my advice on that is to, and here's what it says: does materiality get considered, for example, only 2 leases, a building lease inherently material and a copier lease capitalized at 11,000? May I consider the copier lease not material? That's a discussion that I would have with your auditor. As there is with most standards, there isn't a materiality threshold put in this, but there's a reality threshold. If you've got 1 copier lease, perhaps that's not material. If you had 10, that probably is material, but that's a discussion that you really need to have with your auditor, and something that would be good for you to discuss up front to make sure that you actually have agreement on that, so you don't go down the road of thinking, oh, this isn't going to be material, and then you get into the audit and all of a sudden, you're looking at an adjustment relative to something like that.
Yeah, that's a great comment, Frank, and I'll piggyback on that. I was doing some work with a gentleman from the Center of Plain English for Accounting who did some other webinars on the new lease standard, and that question did come up: was how do we determine whether a lease is material or not? And just like Frank said, there's no black and white number. If you were under the international standards, under IFRS, they do have a threshold of $5,000 as their black line in the sand. We don't have that for GAAP, and what some companies are doing, since this is a little bit of a gray area, is setting some kind of lease capitalization threshold, and we don't have the answer to what that number is, but as long as there is a reasonable judgment behind it and the company is consistent in applying it. Now, of course, you can't say, well, our threshold is $200,000, so we're not going to capitalize anything below that. That's taking too far of a leap there. But if you're doing something reasonable based on the materiality of your financial statements, I think there is some room there to not potentially capitalize every single piece of equipment you have.
Yeah, and one other thing I'll mention here before we move off of this slide. So, for example, say you decide to set up all your leases as 1 year or month to month, but you actually stay in that property for several years. The standard isn't going to allow you to not account for it under the standard because of that. So, you can't kind of work your way around it by drafting your agreements that way. That's not allowed. So that will get caught through the audit process. And before we move on, let's go ahead and launch our first polling question. Okay, so how much time do you believe it will take your company to adopt the new ASC 842 standard? Less than 10 hours, 11 to 20, more than 20, or I have no idea? I'm gonna let that run for a second here as I move to the next slide. Looks like most people are in. Remember, if you need CPE, please answer these questions. That is the kicker for it. So we're about 34 of 40. I'm going to go ahead and end this poll right now, and we will take a look at it. So, there's a decent amount of you that have no idea, which is not surprising at this point based on what we're actually seeing. First year, I think it's going to take a little bit longer. Those of you that are in that less than 10 bucket probably don't have very many leases, but if you've got 5 to 10, maybe 15 leases, it's going to take you a little bit of time to get through this, and you might need a little bit of hand holding. So we'll go ahead and I'll share those results real quick. You can see that, and we will move on. So I'm still really amazed that we're talking about the rate implicit in the lease for private companies. Using the IBR or risk-free rate still seems like such an easier way to go, especially if you only have a few leases. And if you're confused about that or want to talk, please reach out to us. We're happy to engage in a discussion with you on that. So let's talk about some tax considerations now, because this is something we haven't covered in the past, but I think is going to be relatively important for you as well. So, Joe, let's walk through some of these more common ones.
Absolutely, Frank. What we're going to do is present a very high-level summary of the tax considerations here. We're not going to get into the tax code or the tax regs too much. I just want to present 3 or 4 ideas or considerations that we think are pretty common in the marketplace, and the kind of the key theme here is You're going to need to track some of these things because the way we're doing things now for book purposes under the new standard might be different for tax purposes. And so let's get into a few of these here. So really, as we all know, book and tax aren't the same. They don't always talk to each other. So many of these changes we're adopting under this new standard kind of need to be unwound. That's kind of the term I use, which goes back to that idea of tracking some of the numbers and considerations that go into this new standard, especially kind of when you're calculating your right of use asset. That has a combination of a few numbers sometimes, such as initial direct costs. It factors in things like prepaid rent or deferred rent as of adoption date. So some of those things do need to be unwound for tax purposes. One thing that I really want to kind of stress here is that, talking to both your tax practitioner and your auditor, they might be the same firm. Not everybody uses the exact same firm for both tax and audit services, but kind of, regular communication, like I said before, with your banker, your tax practitioner, your auditor, whomever, it's always a good thing. So what do we have here today? I've got 4 topics for us that we're going to discuss. We have if you have a sales and financing arrangement versus an operating lease, leases that are subject to IRC 467, tenant improvement allowances, and lease acquisition costs. Okay, so let's expand further on these here. So starting with sales financing arrangement versus an operating lease, let's do a couple quick definitions for you. In a sales or financing agreement, the lessee is the, quote unquote, tax owner of that lease property, and they depreciate that property under the tax code. Now, payments under the lease agreement are treated as a repayment of a loan, and the lessor is treated as selling this property and recognizes a gain equal to the present value of the lease payments less its basis in the leased property, and also recognizes interest income over the payment term. So you might be a little confused there if you're not too deep into the tax world, but for the lessor side, we're not really diving into that. We're focusing on the lessee side. There was a new standard that did come out under ASC 842 for book purposes under ASU 2021-05, which does affect how a lessor accounts for a sales and financing lease under book purposes. And what it has to do with is if it's determined to be a loss at the inception of that lease arrangement, there's some different calculations that need to be made. Now, this is I haven't come across this in practice yet. I'm just sharing that it's out there. So if that situation does sound familiar to you at all, please contact us and we can take a look at that in a little more detail together. Now, for on the operating lease side, it's kind of how you expect. The lessee does not own the property. They treat the payments as rent for tax purposes, and the lessor who owns the property recognizes depreciation and rental income over that lease term. Okay, so let's see. So next we have leases subject to IRC 467. Again, we're not going to go into the nuances of this standard here. I kind of summarized in a really broad perspective kind of the 3 factors that would qualify a lease to meet this standard for tax purposes. What's really important to know is that the rental income and expense for the lessor and the lessee, again, treated differently for book and tax purposes under our new leasing standard as opposed to the tax code under IRC 467. So back to that commercial, talking to your tax practitioner, talking to your auditor, talking to your banker, just kind of drive these points home to you. Okay, next slide, please. So another common thing that we see is certain costs, we'll call them lease acquisition costs, that are incurred to obtain a lease. I'm going to throw one reg at you. So for tax purposes, under regulation 1.263A-4, this does provide that certain de minimis internal costs incurred, such as employee compensation, overhead related to acquiring a lease, don't have to be capitalized for tax purposes. Now, so what's going to happen is that taxpayers following the book treatment under the new standard who are capitalizing a lot of these initial direct costs, you might be overcapitalized on the tax side. We're probably not talking huge dollars here, but if you have a big lease portfolio, this could be a material number. So this goes back to that concept of unwinding calculations we make for the book calculation and making sure they can be parsed out and separated for tax purposes. Last one here we have is tenant improvement allowances. We do see this a lot in the marketplace as well. And so for tax purposes, ownership of these tenant or leasehold improvements is determined using what we call the benefits and the burdens of ownership analysis. When a lessor that provides a tenant improvement allowance still owns the leasehold improvements, the lessee generally doesn't recognize the allowance as income or have a depreciable interest in these improvements. The lessor does depreciate the assets under IRC 167 or 168. Now, when the lessee owns these improvements, kind of like leasehold improvements, you might be capitalizing in depreciation on your own books. The lessee does generally recognize income and has a depreciable interest in these improvements. Now, that's a lot I kind of threw at you there. You don't really need to take all that away from today. It just goes back to this idea of tracking what is in your lease calculations for book purposes, being able to unwind them for tax purposes so you can provide the relevant information needed for your tax preparer to do your return. So, and really what the takeaway from this is a new standard can be challenging, but if you kind of take it step by step and you track all the inputs, judgments, calculations, numbers that roll up into your new book calculations for your right of use asset and your lease liability, it's just going to make tax time easier for you in the future. And that's all I had.
Thanks, Joe. Companies need to be prepared to track these book versus tax differences. And your advice to speak with their tax advisors is spot on. This is an area where, for a lot of people, it's a little bit uncomfortable because it involves the tax rules, and it's always good to make sure that your tax advisor is on board with what you're doing. So next, we're going to turn our attention to some best practices and lessons learned from projects that we've already completed. Okay, this slide I know is a little bit of an eye chart, so I apologize. There's a few different concepts on here. But these are some of the best practices and ongoing maintenance items that we think you should consider to ensure that you have proper controls in place and that you stay in compliance with the standard. Your finance team has to be made aware of any changes to existing contracts, as someone needs to be assessing the proper accounting treatment and related disclosure requirements. I kind of thought in this post-pandemic world that we might be beyond the concept of lease modifications that we saw during the pandemic, but unfortunately we are kind of staring down a looming recession here, and it's going to be hard to say what's going to happen during that. But you're already starting to see a lot of reports of companies pulling back and stopping expansion, and so the next lever that may get pulled could be trying to get out of certain leases and stuff like that. So it's going to be a topic that I think will be around for the next couple of years. So just staying out in front of it, I think, is super important, especially as we're trying to adopt a new standard here. We also consider it to be a best practice to review recurring contractual payments to ensure that you're capturing all of the lease payments. So what I want you to think about there are variable lease and non-lease payments like CAM charges. You need to ensure that they're properly captured for accurate financial reporting. And by the way, Jess will show you that LeaseCrunch can actually do that for you when she goes through her demo in just a few moments here. And then, from an internal control standpoint, we always think it's a great practice to have somebody independent of the person that actually pulled the data together to go through and review it. Just to make sure it's complete and accurate. You don't want that responsibility lying on just one person as they're going through all of this. The other thing that's important are the key renewal dates to monitor future payment changes and contract option triggering events. Again, that's something that LeaseCrunch has some custom fields built into it to help you track all of that stuff. And then finally, in terms of best practices, this is one that kind of, I think, falls by the wayside a lot of times, but making sure that if you are using a gap checklist as you prepare your financial statements, just making sure you got the current one. There'll be a lot of items in there that will help, flush out potential disclosure issues that you may not be considering. And so with that, I think we will try and pop up polling question number 2. And that is, have you started the adoption process? So it's a yes, no, or an unknown. And this should be somewhat telling, I think, as we head through this. So this is kind of in line with our expectations based on what we're seeing in practice. I'll let it go for another second here. We're up to about 34 responses, 35, which is what we had before. So I'm going to go ahead and end that and then let you see the results. So about 30% of you said yes, about 50% said no, which unfortunately is pretty much what we expect based on what we're seeing out of our own practice at this point. And then 7 of you are still a little bit confused as to where you are in the process. I assume there's some humor in that, but potentially also just a little bit of general state of confusion. And once again, we're here to help. So I will stop that. We'll head back over to our slides. And then Joe, you're going to cover some lessons learned from early adopters. So let's get into that.
Can do, Frank. So I've most of the early adopters I've worked with, or just kind of been a fly on the wall reviewing an audit file for some other practitioners in at our firm. They've all been done via Excel, and none of them were done using a software tool yet. So these are kind of the tips, tricks, best practices, hiccups, things like that that I've seen just using Excel for the adoption process. So starting here, let's look at bullet point number 2. Everything that I've listed here on this slide, these all need to be accounted for and tracked separately. And anytime there's a change to the original payment schedule due to maybe a lease modification, which commercial to go back to some of our other webinars, we talk in depth in some of our previous webinars about what a lease modification is, what qualifies for a modification, and how you have to account for that modification. But really what happens is if there is a modification, there's going to be a recalculation of your right of use asset, your lease liability, and retracking and updating all these kind of little bits of information that I've shown here on this slide. You need to do that. Now, doing that in Excel, it can be done. I'm not going to tell anyone it can't be done. It's time consuming and it takes a lot of effort. And you might see some shortcuts you could take using LeaseCrunch later in the webinar. So third bullet point here, kind of piggybacking on that idea of doing it in Excel. I was looking at a client that had, I would say, maybe six or 7 operating leases. Maybe one had a sublease arrangement and a couple of nuances to the lease with some CPI increases to the rate each year and things like that. So relatively generic leases, but a few things to consider. And what I want to emphasize is that I believe there was almost maybe 15 or 20 different columns used to track everything from the present value factor calculations, the net present value after each month, things like the beginning and ending balance of the lease liability monthly, what's paid in cash, what the actual expense is for book purposes, the interest factor, the principal balance factor, amortization of your right of use asset, things like that. These were all tracked and calculated in a separate column. And it's a little bit of a, an eye test and an exercise in really being detail oriented, accurate, and complete with your work. So it can be time consuming. And as you know, the more factors, calculations, spreadsheets, columns, tabs, etc., that does open up the opportunity to a calculation error, a transposition, something like that. So just kind of laying the foundation for that idea for you here. Okay, so next slide here. So the other thing to consider is drafting your accounting policies. There is a robust disclosure required both for the accounting policy side as well as the actual lease footnote side. And I've kind of summarized some of the information here on this slide that needs to be disclosed. And what's important to note is that CPA firms can assist with this process. We can help, we can guide, but we always have to factor in the concept of our independence and really making sure that the company who is taking ownership for these financial statements, policies, disclosures, etc., they have to, really have the knowledge, the skills, and the understanding to take credit for any of that work. Now, what I will say is that LeaseCrunch has some great wizards, tools, and questionnaires that kind of assist with this whole adoption process on the accounting policy side and the disclosure side. Things like calculating your weighted average for the lease life remaining or your weighted average for your discount rate. If you got a dozen different leases, that could be a hefty calculation. And leveraging a software tool that can do it for you in 5 seconds, versus however much time it might take you, that's a good thing to consider. So here on this next bullet point, I'll call this bullet point number 5. I kind of want to, take us back a few years to when we all adopted ASC 606, which was at the time the new revenue recognition standard. And you probably remember that there's risk associated with a new standard, there's a learning curve, and it can be a little bit of a challenge to adopt that first year. So kind of potentially using a leasing software, it's going to reduce time and calculations on the spreadsheets. It's going to help validate the footnote calculations and some of the other testing areas within the new standard. Now, the great thing about LeaseCrunch is it has what is called a SOC 2 report associated with it. If you're not quite familiar with what a SOC 2 report is, really what it is an independent audit firm did an audit of some of the service organization controls, if you will, that relate to some compliance standards set out by the AICPA. So, word salad, what does that mean? Independent work has been done on the validity and, the use of this software, and there can be some reliance put on the work that it does that prevents the auditors from having to recalculate, reperform, and dig in deeper, maybe if you had just used Excel for the adoption process. So something to consider potentially time saved for your auditors on this process as well. Okay, lastly here, I mentioned this before, but I'm just going to mention it again. There was one client I looked at who did fall out of compliance with one of their covenants from the new standard. They were able to work with their bank and get a waiver for that covenant and kind of, deal with that issue at the end. But it's just, again, this advertisement to talk to your banker ahead of time about how this new standard might affect some of your covenant calculations.
Okay, so here's just a brief slide on the approach that we're taking to all of this. And what we've really tried to do is simplify our approach and the services that we offer so we can meet you where you need support and where you need help. And, some of you may want to outsource a lot of this to us. Some may just need some assistance with portions of it. If we're more involved, like Joe said, you're a test client of the firm, you need to make sure that you're taking full ownership of the process from an independent standpoint. And what we're seeing in practice is some folks are fairly well prepared, some are not fairly well prepared. And so, like I said, we can do as little or as much as you need. In practice, what we're seeing is in year one, companies tend to want a little more hand-holding, and that's fine. And then, they're telling us, hey, after the first year, we'll take the whole thing ourselves. And so, the main message here is we're here to help. And if you need our help, great. If you just need the software tool, that's great. LeaseCrunch is only available through a reseller like us, so you can't go direct to them and purchase the software. Jess, if I got that wrong, mention that in just a second when we move into the demo, but I believe that's accurate. And really where we like to start, if you've got a bunch of leases, we really need to step in and do a bit of an assessment of where you're at. And, we've got some checklists and some tools that we use. So it's not a real cumbersome process, but we can certainly step in and help you with that, especially if, as we're rounding into the fourth quarter here of the year. If you're a calendar year end, the clock is ticking, and we certainly want to get out in front of it as much as possible here. This is not something we want to leave until the first quarter of 23 when we're trying to, work with you on an audit or a review or something like that. So, where we see the challenges are in the concepts of variable leases and embedded leases. We'll mention a couple of things relative to embedded leases. We have not seen a lot of this in practice, but what the standard talks about are IT service contracts. So if you've got an underlying dedicated server, if you're a much larger company, you may have something like this. Technically, that server would be considered to be leased. And then this is something a little more common in our manufacturing and construction practice. But in manufacturing, if you have your product contract manufactured by a third party and they have some specialized equipment that's used only for you, that could technically be an item that you're leasing. And then, like I said, in construction, if you've got a fleet of assets that are dedicated to you, those may be something you need to consider from a lease standpoint. So with that, I'm going to turn it over to Jess. Dee, should we do another polling question now, or do we want to wait until after Jess does hers?
Well, let's go ahead and pop a polling question.
Okay, let's do our third polling question so we can get this in, and then we'll move over to Jess. So which are you planning to use to track your leases, account for new requirements under 842, and prepare required journal entries for adopting and monthly accounting purposes? So we got Excel, automated software solution, both, or undecided. We'll wait for a few more to roll in here so we can make sure everybody gets CPE that needs it. 35 is about where we've been, so I'm going to end it and we'll put these results up. Here are the results. So, kind of a mixed bag here. Still about a third of you are in Excel, about 25% or so in an automated solution, a smaller percentage for both, and a bunch that are undecided. So once again, pretty much what we expected to see there. So we are going to move over into the LeaseCrunch demo. I will stop sharing, and Jess, you can take it away.
Thanks, Frank. Good stuff here today. Lots of topics that we have seen before. Frank, let me know you can see my LeaseCrunch screen here.
Yep, you're good to go.
All right, thank you. So a little bit about LeaseCrunch. I know we kind of talked about this before, and if some of you have been with us at in our other webinars, you'll know that we are a cloud-based solution. The great thing about LeaseCrunch is that we are integrated with your firm. So, SSF is a reseller of ours, and you're able to call them, and they're able to help you get started. We have a full support team staffed by accountants. So we are just like Joe and Frank. We've been in the industry in some fashion or another. My team likes to remind me that I've got well over 20 years in this game. I like to not listen to them when they say things like that. So the first thing I want to talk about, Joe mentioned practical expedience. So one of the things that we have here in LeaseCrunch under our administration menu is a policies section. Our policies section is going to allow you to download our policy election template. We've got those here linked into our software. You can download this election template, which I've already got one pulled up here for you today. This will help you walk through those specific judgment-based decisions you'll need to make. I saw there was a question in the chat about short-term leases, or Q&A rather. The short-term leases is for leases that were 12 months or less and does not include a purchase option. So for that question that came in about that lease where maybe my adoption date is 2022, but I only have a few months left, we're going to take a look at that entire lease. And if it's got longer than 12 months, you're going to need to be recording that. So the thing about our policy election template is that it's a Word doc. You'll be able to walk through making the decisions that are relevant to your organization and then upload that right back into LeaseCrunch. And like I had mentioned, the SSF team has access to your leases, so they'd be able to see the decisions you made as well. I think Joe mentioned a lot of judgment-based decisions that would go into our footnote, and this is a great way of documenting those. The other thing I want to talk about is some customization, reporting entities. If you have multiple reporting entities, we can fully support your additional entities. And then questions are coming in about initial application date as well. Remember that your initial application date is based on your fiscal year end. It's not a random arbitrary date that you're choosing. It is going to be the fiscal year beginning after 12/15/21, unless you are restating prior periods. A policy election, more judgment to be made there. We can fully customize LeaseCrunch, so there's a lot of decisions that you can make. There's a lot of different reporting that you can do. You can also customize your reporting entity and GL accounts so that when you are running your journal entries out of LeaseCrunch, they will be in the GL format that you need to import into your financial system. Next, let's take a look at entering a lease. It takes about 3 minutes to enter a lease. As the guys kind of already talked about, determining that lease portfolio, making sure you've got everything identified is kind of this big chunk of time prior to entering the leases. We've tried to make lease entry into our system very easy so that, by the time you get to this point in the lease accounting implementation, you're ahead of the game. So we're going to enter an office lease here today. Description and manufacturer are optional fields. If that's something that's helpful to you, you can certainly add them. Our next required field is asset type. Oftentimes when we're doing trainings and support, we have questions about how many fields are required. I think there's 12. So there's a lot of extra fields available. As Frank talked about earlier, we have the opportunity to customize quite a bit of information as well. So if keeping track of your leases by location and lessor is important and helpful, you can add that information here as well. We also talked about wizards. So here in LeaseCrunch, we've got a couple of wizards. If you're using ASC 842 side of our system, you'll have a lease term wizard and a classification wizard. And let's enter a lease that begins on the same day as our initial application date, so the date we're adopting this standard. We're going to enter transition leases so that we can also account for those existing balances under 842. We'll enter our remaining lease term here. That might be 6 months in some of those scenarios where our leases are getting toward the end while we're implementing the new standard. And the lease term wizard is going to ask you about your early termination and renewal options. This part of our wizard is a decision tree, so it will guide you through the decisions you're making about this particular lease. And one thing I think we kind of briefly talked about today, or maybe in some of the past webinars that we've done, is communicating this information with the other people in your organization who might be involved. So for example, the accounting team might get this lease and not really know about, what are our plans for this particular lease. It might be important to have those conversations with other stakeholders in your organization. Are you reasonably certain to exercise a purchase option? And if you are, the system is going to ask you for a new end date. So it's really, built to help you navigate through adopting the standard and making the good decisions that are then documented in the audit trail for your auditor. When I finish through my wizard, we're going to see that my start date, end date, and term are filled in for me, as well as my ROU asset life. And then I've got the opportunity to include comments. This might be renewal options or termination options, and then finally the opportunity to record custom fields. When I hit next, we're going to save progress and move us forward. So this Add Leases workflow really walks you through the steps that you need, and that brings us to our lease payments and classification. As you can see, the first step here is going to be discount rate, and Joe talked a lot about discount rate already today, kind of a refresher. When you select the blue question mark next to discount rate, you're going to see our discount rate guidance. We talked today about our implicit rate and knowing that we're going to need to have some information in order to calculate our implicit rate if it's not actually stated, and we've built an implicit rate calculator for you. And for those non-public organizations that are also choosing to use that risk-free rate, we've linked those here in our help guidance as well. So not only have we built a software that is hopefully easy to use, but we also have quite a lot of help guidance within this as well. So we'll enter our discount rate. Remember, for a transition lease, our incentives received and initial direct costs have already been accounted for, so we're not going to enter that here. And then we're going to enter our payment information. For those transition leases, it's going to be your remaining payments, so whatever payments are left on that lease term. For any brand new leases, we'll enter all of our payments. And if you're needing a little help determining what counts as a lease payment, we have some great guidance under this blue question mark as well as a calculator to help you determine increases in leases, etc. So really handy information, great tools available right at your fingertips. The next section on this particular screen is for existing balances under previous lease guidance. This is for those balances you may have on your balance sheet as you're adopting the new standard. So for finance leases that were formerly called capital leases, you'll see capital lease asset and liability. You might have deferred rent or some unamortized costs that you need to include. And then everything will flow through the ROU asset as part of your initial journal entry. So the system does the work. And then finally on this screen, we've got our classification wizard. Our classification wizard will help you classify this lease as an operating or finance lease. Under the new standard 842, we've got 5 criteria to help us classify this lease. There was 4 criteria under 840, so this has changed a little bit. And our system will help you guide through making sure you've got the correct classification there. I bet your auditors will also like that as well. So I'm going to classify this lease, and then I'm going to hit next. Here in the system, then we're going to see our GL accounts. Our GL accounts are pre-filled because we have customized those on our administration menu. So for this operating lease, we're pulling only the operating lease GL accounts in. If you have more than one account, it's going to be listed here in your dropdown. you just one account, it'll be pre-selected for you. And for those of you who have cost center allocations, you're also going to be able to allocate those expenses, and LeaseCrunch will make sure to make that math add up to 100% for you. Couple more stops on our Add Leases tour. Variable expenses. I know Joe talked about this earlier. Some of the lessons learned is making sure you're tracking those variable expenses. You can add that information right here in LeaseCrunch, so then you're showing that on your footnote as well. And then step 5 is document storage. So a great way to keep all of your lease information is in one spot is to upload your lease documents right into our system. Unlimited file storage here, and we're built on the Microsoft Azure platform, which our SOC report will, I think, talk about. And then finally, we have a review and approve function as well. For those organizations who maybe want a second set of eyes on leases before they are reported on, this review and approve function is a really great tool. Someone else in the organization can take a look at that lease before you start running reports. When I hit that submit for review button, then we're going to go back over to my leases, which is where you begin when you log in to LeaseCrunch. The first thing I want to do is just talk about the sorting. So here at the top of the screen, you can filter your leases by selecting any of this information. So as I select the checkboxes, you're going to see the portfolio of leases is narrowing down. Next, let's take a look at reports. So as we talked about earlier, that footnote is really important. We also will give you journal entries and amortization schedules. You can customize your journal entry columns in an order that works best for you. And again, all of the reports from LeaseCrunch are going to export into Excel into a format that's pretty easy to use. So we're going to see our initial journal entries here at the top. So the initial recording of your ROU assets and lease liabilities for those finance leases, your first month of entry, and then you'll see those operating leases next. Subsequent months will then follow. The criteria tab of any of the reports you get from LeaseCrunch is going to include any of that filter criteria. So I filtered this down to one reporting entity. You're going to see your GL start and end date. And you're also going to see the leases tab. And this leases tab shows you everything about these leases. Next up, let's take a look at that amortization schedule. So our amortization schedule is going to export out into Excel. And a great tool to use to reconcile to your GL. So make sure that you didn't miss anything on those monthly entries. Your amortization schedule also has that criteria and leases tab before. And then finally, that footnote. As we mentioned already, that footnote is going to include the things that are maybe a little or a lot more difficult to calculate in Excel. Our annual lease expense information, you're going to see your other information here. Things like ROU assets obtained in exchange for new lease liabilities, your weighted average remaining lease term and discount rates, as well as your maturity analysis, all separated by finance and operating leases. You'll also see that criteria and lease tab again. So all of your reports will include those criteria and leases, so you'll know exactly what was included on the report. A great thing for your auditors as well. We can also do revisions, as Frank and Joe already mentioned, as we're heading into the future of our economy, not knowing what that might look like. We can support those revisions for you as well. And like I said before, cloud-based. So we're always up. We're built on the Microsoft Azure platform, and it's working really well. Frank, back to you. Anything else?
No, I think that was terrific, and I know we covered a lot of information there in a relatively short amount of time. I hope everyone can see just how relatively simple it is to go ahead and work through the software. Obviously, Jess is a pro at it, and all of you will need some time to get there. But you will get there, definitely. Let's go ahead and launch our next polling question. And can you guys, Dee, can you confirm that you can see my screen again?
Yes, I
Yep,
can.
looks good.
Okay, great. So the last question we have here is, how many leases does your company have, both financing and operating? So the lion's share here is what we thought, kind of 1 to 5. You guys are going to be the easiest ones to adopt and get through. We've got about 36% of the population here that have more than that. Those of you in the 15 plus bucket, I cannot stress enough. I'm going to go ahead and end the poll and share this. please get out in front of this. This is not something you want to leave until year end. And it can be a much simpler process if you start now and start using a software tool to get this taken care of. Okay, so let's move on to the next slide. We get a lot of questions around, well, what does pricing look like for all of this? And I think this is where, as they say, the rubber hits the road when you think about using Excel for something like this. For most companies, what it's going to be is about $11 to $15 per lease per month for the software. So just, for rough ballpark numbers, somewhere around, 150 to 175 bucks a year per lease. That's pretty inexpensive. I've had some consultations that I've been on with companies that have talked about, talking with other software suppliers that are quite a bit more expensive than that. So I think you get all the bells and whistles with what you've got here in LeaseCrunch that you're going to need. So our goal is to bring the right technology to our clients. And there was a question in there about, hey, I'm not a client of SSF. Can I still, get LeaseCrunch through you? Absolutely. We're here to help as many companies as possible adopt this and get through this. And like I said, we think with a technology solution, it's going to make your life so much easier. With everything else you've got to deal with, let's just knock this out of the way and move on from there. And then in terms of total implementation, it really depends on how much help you need, right? And what we're seeing in practice is a little more help in year one and not as much help going forward is what we're seeing in practice. So I think we can set up a reasonable statement of work for you folks if you need help with all of this. So please don't hesitate to reach out. I'm going to move to the next slide now, which basically says, hey, our reporting date is here. Try to get out in front of this as much as possible. If you need our help, reach out. If you want to schedule a 15-minute consultation, please do. We're happy to hop on the phone with you and get on a Zoom call and walk you through, and answer your questions for you. This is something that doesn't have to be overly difficult, and for many of you it won't be, but if you put it off and you don't invest a little bit of time in it, it's probably going to be a little more challenging than you would want at this point. And so with that, let's look. We've got a couple of questions that are looming out there. I know, Elena, you had a couple that came in right away, so let's try to answer those now. Joe, Elena says, if I use the risk-free treasury rate, should I use it for every agreement? Or if the IBR is available for some leases, can I use the IBR?
So I'll just clarify there a little bit. So the IBR is something that you can calculate for every lease you have. That just takes a little bit of analysis to do. So the implicit rate, that first rate, that's the one you must use if it is implicitly stated in your lease. Going back to that, not seeing that in many leases. So typically, if you make that election to use the risk-free rate, which many companies are doing because of the time saving and the removal of the judgment in the calculation piece, you would want to apply that risk-free rate to all of your leases that don't have that known implicit rate in the lease.
Okay, great. And then this is a question that may not be able to be answered live on the air because there's going to be a bunch of but-fors related to this. So it says, it would be great if you can comment on intercompany operating lease presentation, standalone as well as eliminations. So there's a lot in there to unwind.
Yeah, so the answer I will give is depends, because every company that has a tricky or big consolidation with, parent companies, subsidiaries, wholly owned or not wholly owned, it's going to be tricky. Now, the easy question I can give you is, if you're doing a standalone financial statement presentation of maybe a sub that isn't the full parent company, that would just kind of be how we've described it today. You would have your right of use asset, you would have your lease liability, and go through the exercise of the disclosures in the accounting policy for that standalone entity. On the whole consolidated level, when you're talking about things like eliminations, whether it's rent income, rent expense, the lease liability, the lease receivable, that gets really detailed. So we don't have a great answer for you on that today, but if you do want to discuss more, we'd be happy to help.
Yeah, that one unfortunately can be a bit tricky. So I apologize for not being able to give a better answer than that, but there's a lot of nuances there that we may need to potentially work through. So we are at time now. I want to thank everyone for participating. If there's any other questions, shoot them into the Q&A right away. One thing I also wanted to mention is we do work through other CPA firms as well. So if like the one question that came in, if you work with another CPA firm, you can still get the software through us, or we're actually working with some CPA firms where we provide the software to them to use for their clients. So there's many different ways that we can help here. So the most important thing is just to reach out. Hopefully you've enjoyed these series. If there's things that are out there in the public domain that you'd like us to do some webinars on, please communicate that back as we do our follow-up. We really like doing these presentations and bringing as much guidance to you folks as possible. And we would love to be able to come back to you with additional items as we move forward. Don't forget to hit the YouTube channel, and thank you all for participating today. Bye now.